Hello, and welcome to another one-to-one mining investment online APAC content session. Today, to speak on the outlook for nickel, we have Angela Durrant, Senior Research Manager at Wood Mackenzie.
Thank you, Amy, and welcome to this year's AsiaPac one-to-one mining investment conference. It is very clear that nickel prices are being buoyed by the energy transition, which for nickel has meant ever-increasing interest in the electric vehicle supply chain and production of nickel sulfate to feed electric vehicle batteries. Today, I'm going to provide you with Wood Mackenzie's view of the nickel market and how we expect supply, demand, and prices to change over the short to longer term. If we look at the last 18 months of price data, we can see that some of the metals we cover that are part of the energy transition story, namely copper, cobalt, aluminium, and nickel, have climbed significantly from March 2020 through to October this year. For nickel in particular, we can see that after recording a low of $11,055 per tonne on March 23rd, 2020, prices increased steadily for the next 12 months. However, as you can see from the red circle here on the left-hand side, in early March this year, prices dropped by a staggering 20%, following the announcement by China's Tsingshan that it would convert some of its MPI lines over to matte at its Morowali Industrial Park in Indonesia. This sent the market into a spin, breaking the previous view that the nickel market would be oversupplied with nickel pig iron and that the market would struggle to find the nickel required for batteries. Tsingshan had effectively come up with the answer. The nickel required for the battery route would in part come from matte processing. Since Tsingshan's announcement, nickel prices have largely returned to their upward trajectory, supported not only by the EV story, but genuinely solid fundamentals, record high demand, tight supply, and record low stocks. All of this has contributed to considerable growth in share prices for many nickel miners and explorers. Focusing here on some of the Australian companies, going back to our index date of March 23, 2020, the Independence Group is up a whopping 288%, Western Area is up almost 200%, Minco by 345%, and Poseidon by almost 428%, and Panoramic by 238%, meaning that there are a lot of very happy investors out there at the moment. We should note that the Independence Group is actually a great example of one of the companies that has diversified in order to really capture more value from the energy transition story by expanding its portfolio into lithium production, which, as I'm sure you're aware, is another key input into EV batteries. So given the excitement around batteries and EVs, I thought we would cover our views on this first before heading to the market fundamentals. If we consider nickel consumption by first use, stainless remains the market's main consumer, currently accounting for around 70% of total consumption. However, looking out to 2040, this share drops to 53% as battery precursors for EVs and energy storage become increasingly more important. In 2020, we estimate that battery precursors for electric vehicles accounted for 7% of total consumption. But by 2020, we expect that this share would have climbed to 30%. In this 20-year period, we are forecasting consumption of nickel to more than double from 2.4 million tonnes in 2020 to 4.9 million tonnes in 2040, meaning that nickel consumed in stainless will reach 2.58 million tonnes compared with 1.7 million tonnes last year. And nickel consumed in batteries will actually reach 1.5 million tonnes by 2040, compared with only 177 kilotonnes in 2020. The bottom line is that we are anticipating solid growth in demand for battery precursors above all other first-use sectors. This view is supported by our projections for electric vehicle car sales over the same 20-year period. We currently forecast annual sales of passenger electric vehicles to exceed 49 million in 2040, compared to around 3 million in 2021 and 2 million last year. These sales are represented by the dark blue bars, which we can see here in the chart on the left-hand side. In terms of battery chemistry, and looking to the chart on the right, we expect that the current dominance of 532 and 622 in NMC battery types will give way to high nickel, like 811 types by 2025. As the chart illustrates, the NMC 811 and the LFP, the lithium iron phosphate types, will provide the majority of required gigawatt hours for electric vehicles from 2030 onwards. Indeed, by 2030, we expect that all NMC batteries in use will be 811. At this point, high nickel and lithium ion type batteries will dominate, and we expect that the split between non-nickel LFP will be around 25%, NCA 10%, and NMC 65%. And this will not change greatly over the longer term. Obviously, battery developments are continuing apace, and in the next 10 years or so, it is quite possible that other configurations may find favour. But in terms of what is commercially applied right now, this is how we see the market developing. In terms of nickel, the progressive dominance of 811 will boost consumption, and this will be countered by lower intensity of use, or it will be countered by lower intensity of use, pardon me, as battery pack sizes get smaller due to increasing energy density. So taking a step back and looking at demand for battery precursors or nickel sulfate on a regional basis, we can see that China will be the main consumer in the years to 2030, as we can see by the yellow area on the left-hand side. In 2021, we estimate China's demand for nickel in precursors will total 211 kilotons of nickel and increase to almost 700 kilotons in 2030. The chart on the right shows the nickel sulfate supply versus demand has largely been in balance in recent years, but it is likely to move into surplus from 2022 to 2025. And this increase in sulfate supply from this year is largely connected with Tsingshan's commitment to provide an additional 75 kilotons of nickel in matte to the battery supply chain from this October from its Morowali facilities in Indonesia. And this is what I alluded to in the first slide with the price fall in March. It was all around this kind of announcement. But in addition, there will be the commencement of production from HPAL facilities in Indonesia also. One of these, PT Halmahera Legend, commenced shipping a mixed hydroxide precipitate to China in June-July this year, and the other two HPAL plants are expected to commence operating in 2022. However, with little supply side visibility beyond 2025, we expect demand growth to catch up and push the market back into deficit shortly after. So we do believe that there will be a need for investment in new sulfate capacity, and starting now, if we are to avoid prolonged deficits in this rapidly growing market. While China will dominate demand for nickel sulfate, it will also be the largest centre for production over the forecast period, showing here out to 2025 on the left. In Australia, BHP at its Kwinana refinery has also commenced production of nickel sulfate, which is shown here in the green area on the left-hand side, and Indonesia is also becoming a producer of sulfate in 2021. Over the next 5 years, we estimate that nickel sulfate will be sourced from various different types of ore bodies, predominantly laterites at 37%, sulfide deposits at around 40%, so in similar volumes. Dissolution will account for around 15% and recycling around 8%. The big consideration here is what part recycling will play over time. As the chart here on the right-hand side illustrates, we expect that recycling will provide up to 20% of new nickel units by 2040. In fact, we would be so bold to suggest that the saviour of future nickel supply could be a redirection of investment funds towards recycling. The inherent qualities of recycling make it attractive. A potential lower environmental footprint combined with the social message of removing what has hitherto been material going into landfill. There are several new entrants in this field already, with the pace picking up since early 2020. From collection and processing of spent batteries through to reusable products they will make. There are many differences between the different players' intentions, but most share a commonality in their small size, typically less than 10 kilotons per annum of nickel in black mass or sulfate, and a potential for scaling up by a factor of 3. While China already accounts for the bulk of spent batteries being processed and will remain the market leader, recycling is gaining traction outside of China. We're seeing high rates of investment in new plants across Europe and the US, as well as Asia. One of the most recent announcements has come from the South Korean conglomerates of Hyundai, Motor Corp, LG Energy Solution, who will start building a 10 gigawatt NMCA battery cell factory in Indonesia from the end of this year. The partners intend to take MHP, or mixed hydroxide precipitate, from the new Obi nickel smelter in North Maluku province in eastern Indonesia, which is represented here by the grey bars on the chart on the left-hand side. A subsequent project is for the precursor cathode active material, or PCAMs, and a battery recycling plant in Central Java province. In other words, new players from the downstream nickel consumer business segment, or first-use chemicals and end-use autos, are obtaining their own funds to guarantee raw material supply, bypassing conventional industry names and financing routes. So now we will switch focus and look at overall nickel markets and Wood Mackenzie's current view. Our current outlook for the short-term nickel market is one of tightness. Following the stagnation of demand in 2020 due to COVID-19 pandemic, demand has surged, with most of the leading nickel consuming regions returning to their 2019 levels. We currently estimate demand to increase by a whopping 17.3% in 2021 to total 2.8 million tonnes, firmly bringing the market back into balance following last year's surplus of more than 150,000 tonnes. The rebound in demand, coupled with future nickel in electrification, has supported high nickel prices in 2021, and we currently estimate an annual average price of $18,475 per tonne, or $8.38 per pound. The strength in prices will continue in 2022 before falling as small surpluses build over 2023 and 2024. Although this decline in price, we should say, over this period will be rather moderate. The strength in 2021 and next year has been buoyed by very strong Chinese demand for nickel in precursors for rechargeable batteries, as we looked at earlier, but also due to reduction in supply expected from Indonesian NPI. Consequently, from 2025, the market will experience a 6-year period of price supportive deficits, averaging around 60 kilotons per annum through to 2030. Looking at our stainless demand analysis in a little more detail, we estimate that in 2021, global production will increase by 14% compared with 2020, with China expected to account for 58% of global melted output. The country's stainless sector is still expanding, with output forecasts to rise from 35 million tonnes this year to 45 million tonnes in 2030. The other country experiencing growth is Indonesia, where Geelong Obsidian is ramping up its second line and Tsingshan is operating well above capacity at over 4 million tonnes. Indonesia is now heading for 5.5 million tonnes of stainless melted production by next year, which is remarkable given the industry didn't even exist in 2016. China's production of stainless is very much leveraged to nickel pig iron. We can see from the grey bars that in 2019 and 2020, China started to favour imported nickel pig iron for its stainless production. The volume of imported Indonesian NPI almost doubled over this period. And the move to import more Indonesian NPI has meant that China's requirement for both Class 1 nickel, which is now down 248 kilotons since 2016, and imported ferronickel, which is down 20% since in 2021, has fallen. However, despite these decreasing volumes, we expect that Chinese ferronickel imports will start increasing again from 2022 onwards, as Indonesian ore is converted to matte for batteries rather than into NPI, meaning that there will be less nickel pig iron available for import into China. And depending on price, this will determine if, in fact, more Western ferronickel is imported, or if China starts to use more scrap, if nothing else, to support the move towards a greener economy. Looking to the other side of our supply-demand balance and considering production, the two charts above highlight growth in both mined and refined output since 2019. We can clearly see that NPI from Indonesia has been driving the production increases at both the mine and smelter refinery level, prompting double-digit growth in laterite ore production in both 2019 and 2021. Overall, we expect global mine production to increase by almost 17% in 2021 and refined output to increase by 11% compared with last year. Over the next few years, nickel pig iron production growth will continue to be supported by developments in Indonesia. NPI production in Indonesia will actually increase to 1.1 million tonnes by 2024 and remain around this level until other nickel pig iron projects are developed. It should be noted that restrictions on NPI capacity are possible. Earlier this quarter, Indonesia's Ministry of Energy and Mineral Resources announced that it was considering a plan to restrict the construction of new NPI and ferronickel smelters. The proposal seeks to optimise the use of nickel resources for higher value products, which in turn would increase royalty revenues. The government wishes to develop a more complete value chain with the production of more stainless steel as well as nickel sulfate. For the present, this is for discussion, but any restriction on further nickel pig iron production growth in Indonesia would be viewed very positively from a price perspective. However, given the number of safeguarding and anti-dumping duties now imposed on Indonesian stainless steel, one can debate whether there would be a viable market for stainless from new projects in Indonesia. When we compare the amount of nickel pig iron produced versus the amount likely to be consumed by Indonesia's two main stainless steel melt shops, it's clear that there will be considerably more nickel pig iron available for export, principally to China's owner stainless smelters. So the Indonesian government could view this in two ways. Do we continue to permit the export of a low value-added product to support China's stainless sector? Or do we place some restrictions on NPI exports and encourage further redirection of these nickel units into the ore to matte route for batteries, serving our domestic battery cell manufacturing plants? The first investments in those downstream plants via Korean conglomerates, as I've mentioned before, Hyundai and LGES, have just been announced and will use Indonesian-produced MHP. But it must be tempting for Indonesian authorities to press for further downstream investment. It will also be good diplomacy to avoid generating problems among those Chinese investors who rely on low-cost Indonesian NPI for their own China-based stainless melt shops. So before rounding off my presentation for today, I wanted to take a quick look at nickel industry costs. As you are all aware, producers and consumers alike are becoming increasingly more concerned with environment, social and governance issues, as well as carbon dioxide emissions. The need to produce clean, green, sustainably sourced nickel has become increasingly important. With this in mind, Wood Mackenzie developed an emissions benchmarking tool, which is where I've generated the data for this slide. The carbon emissions intensity tool illustrates that nickel pig iron producers in Indonesia are high on the emissions curve, largely due to the intensive use of coal for power generation. Large integrated sulfide producers, however, sit much lower down on the curve. And here we have highlighted both Vale and Norilsk as examples. The consideration here must be around the behaviour of consumers as they investigate where the nickel in their EVs batteries has come from. So to conclude and take us back to our nickel demand balance, based on current market fundamentals, we expect that the deficits running through to 2030 will support annual average prices approaching $19,440 per tonne or $8.80 per pound by 2026, followed by even higher prices of $21,000 or $9.50 per pound through to 2029. By then, 4 straight years of metal inventory drawdowns will shrink global stocks towards 100 days of consumption by 2031, a level not seen since 2005, when prices also averaged around $19,980 per tonne. Primary refined supply through to 2031 will struggle to average growth of around 2.5% per year, virtually all coming before 2027. Therefore, by 2026, the market will need to find new nickel, either from our extensive list of probable projects or from elsewhere. By 2031, the requirement for nickel from these sources is estimated to be 570 kilotons, expanding to 970 kilotons by 2040. And this can be seen by the two arrows in the chart. I think it is worth pointing out at this juncture that nickel prices are currently sitting at around that $18,000 to $19,000 per tonne, or actually even higher. And that even at this level, we have not seen banks putting their hands in their pockets to finance new projects, which signals that there is still much caution despite the optimism around EVs and nickel consumption growth. So with those points in mind, that will actually take me now to the end of my presentation and a few key takeaways, which I will leave you to read in your own time. Finally, I'd like to thank the One-to-One team for inviting me back this year and the audience for your time today. I hope to see you again very soon. Thank you.